I remember the last day I worked. I remember driving home from a job site in my truck with the windows down and thinking, that's it. No more early mornings, no more clients, no more scrambling to make quarterly tax payments, no more writing checks to the IRS 4 times a year. I remember thinking, I'm finally done working, done earning, done paying taxes. And I want you to hear me when I say this because it's important. I was wrong. I was completely, embarrassingly, expensively wrong. And if you're sitting there right now in your 50s or 60s thinking the same thing I thought, thinking that once you retire and stop getting a paycheck, the IRS is finally out of your life, I need you to stay with me. Because what I'm about to tell you is going to make you angry. Not at me. At the fact that nobody told you this before. Nobody told me either. My name is Harold. I'm 63 years old, retired general contractor from Scranton, Pennsylvania. 38 years in the trades. I'm not a tax advisor. I'm not an accountant. I'm not a financial planner. I'm just a regular guy who saved his money, did what he was told, put as much as he could into his 401k every year for decades, and then retired, expecting that the hard part was over. The hard part was not over. The hard part was just getting started. Let me take you back to the beginning, because this story starts with my father, the way most of my stories do. My dad, Frank, worked a blue-collar job his whole life, same as me. He didn't make a lot of money, but he was disciplined. He saved. He put money away. And when he retired at 65, he had Social Security coming in every month, and a small pension from his company, and a little bit in savings. He thought he was set. He thought he was done with the government taking a piece of everything he earned. And then he got his first tax return done after retirement, and he owed money. He called me on the phone, and I could hear it in his voice. He was confused. He was frustrated. He said, "Harold, I'm not even working anymore. How do I owe taxes?" I didn't have an answer for him. I didn't know. I was still working at the time, still in my 50s, still years away from dealing with this myself. I told him to call his accountant. He did, and his accountant explained that his Social Security benefits were being taxed. My father, this man who had paid into Social Security for over 40 years, every single paycheck, without fail, was now being taxed on the money the government was giving back to him. He never got over that. He brought it up at every family dinner for the rest of his life. He'd shake his head and say, they tax you when you earn it, and they tax you when they give it back. And he was right. But here's the thing. Social Security taxation is just the beginning. It's the first surprise. There are more, and they get worse. When I retired, I thought I had learned from my father's experience. I thought I was prepared. I had my 401k. I had my Social Security. Linda and I had some savings. I figured we'd be comfortable. Not rich, not extravagant, but comfortable. And we are comfortable. But the first year of retirement, when I sat down with our accountant to do our taxes, I realized that comfortable and tax efficient are two completely different things. And nobody had ever explained the difference to me. Let me walk you through what I learned, because this is the stuff that hit me like a truck, and I don't want it to hit you the same way. The first thing is Social Security. Most people think Social Security is not taxed. That is a myth. If your combined income, and I'll explain what that means in a second, if your combined income is above a certain threshold, up to 85% of your Social Security benefits can be taxed as regular income. 85%. Let me put that in plain English. If you're getting $2,000 a month in Social Security, the IRS can tax up to $1,700 of that as if it were a paycheck. Now, what is combined income? Combined income is your adjusted gross income plus any non-taxable interest, plus half of your Social Security benefits. So if you're pulling money out of your 401k or your traditional IRA, that withdrawal counts as income. And that income can push your Social Security benefits into the taxable range. So you're paying tax on the money coming out of your retirement account, and that money is causing you to pay tax on your Social Security too. It's a double hit, and most people don't see it coming until they're sitting across from their accountant with their jaw on the floor. That's exactly what happened to me. My first year of retirement, I took a distribution from my 401k to pay off the last bit of our mortgage. I thought I was being smart. Get rid of the monthly payment, reduce our expenses. Makes sense on paper. But that distribution counted as taxable income, every dollar of it. And it pushed our combined income up high enough that 85% of our Social Security became taxable too. The tax bill that year was almost $9,000 more than I expected. $9,000. Linda looked at me across the kitchen table and said I thought we were done with this, and I didn't have an answer for her either. The second thing is your 401k and your traditional IRA. This is the big one. This is the one that nobody explains to you when you're 30 years old and your company is telling you to sign up for the 401k and get the employer match. And don't get me wrong, the 401k is a good thing. The employer match is free money. You should absolutely take it. But here is what they don't tell you. Every dollar you put into a traditional 401k or a traditional IRA goes in tax-free. You don't pay taxes on it when you contribute. It grows tax-free for 20 or 30 or 40 years. And then when you retire and start pulling it out, you pay taxes on every single dollar, not just the gains, every dollar, because you never paid taxes on it in the first place. So that 401k that you've been watching grow for 3 decades, that number you see on your statement, that is not your money, not all of it. The IRS has a claim on a portion of every dollar in that account, and the exact size of that claim depends on your tax bracket when you withdraw it. I had a buddy named Tom, worked in sales his whole career, good saver, disciplined guy. He retired at 64 with just over $500,000 in his 401k. He was proud of that number. He should have been. But Tom thought he had $500,000. He didn't. He had $500,000 minus whatever the IRS was going to take when he pulled it out. At his tax bracket, he effectively had somewhere around $350,000, maybe $375,000. The rest was going to the government over the course of his retirement. He didn't realize that until his first year of withdrawals. And the look on his face when he told me about it, I'll never forget it. He said, "Harold, I saved for 35 years and I don't even have what I thought I had." That's the part they don't put on the brochure. The third thing is required minimum distributions. This is the one that catches people completely off guard. When you turn 73, the IRS requires you to start taking money out of your traditional 401k and traditional IRA, whether you want to or not. They're called required minimum distributions, or RMDs. The amount you have to withdraw is based on your account balance and your life expectancy, according to IRS tables. And you have to take it every year. If you don't, the penalty is brutal. It used to be 50% of the amount you were supposed to withdraw. They reduced it recently, but it's still 25%. 25% penalty on top of the taxes you already owe. Now here's why this matters. Maybe you don't need that money at 73. Maybe your Social Security and your pension and your savings are covering your expenses just fine. Maybe you'd rather leave that 401k money alone and let it keep growing. Doesn't matter. The IRS says you have to take it out. And when you take it out, it's taxable income, which means it can push you into a higher tax bracket, which means it can cause more of your Social Security to be taxed, which means your Medicare premiums can go up because Medicare premiums are based on income. It's a chain reaction. One required withdrawal triggers a cascade of additional costs that nobody warns you about when you're 40 and happily contributing to your 401k. My mother-in-law Eleanor found this out the hard way. She's 79. Her husband passed and left her his IRA. She didn't need the money. She was living fine on her Social Security and a small pension. But the IRS required her to take distributions from that inherited IRA. And those distributions pushed her income up high enough that her Medicare premiums jumped. She went from paying the standard Medicare Part B premium to paying almost double, for the same coverage. Because of money she didn't want and didn't need being forced out of an account she would have rather left alone. She called Linda crying about it. She said, "I don't understand why they're punishing me for saving." And she's right. It does feel like a punishment. But it's not a punishment. It's just the rules. Rules that nobody explains until you're already caught in them. Now here's the fourth thing, and this is the one I want everybody listening to really hear, because this is the one that changed everything for Linda and me. There is a strategy that could save you thousands of dollars in retirement taxes. It's completely legal. It's been around for years, and most accountants will never bring it up unless you ask. It's called a Roth conversion. In plain English, a Roth conversion means you take money out of your traditional 401k or traditional IRA. You pay the taxes on it now, and you move it into a Roth IRA. Once it's in the Roth, it grows tax-free, and when you pull it out in retirement, you pay zero taxes. Zero. No income tax on the withdrawal. It doesn't count toward your combined income. It doesn't make your Social Security taxable. It doesn't increase your Medicare premiums. It doesn't trigger any of those chain reactions I just talked about. And when you die, your kids inherit that Roth IRA, and they pay zero taxes on it too. Now there's a catch. You have to pay taxes on the money when you convert it. So if you convert $100,000 from your traditional IRA to a Roth, you're going to owe taxes on that $100,000 in the year you do it. That's real money. That's a real tax bill. But here's the thing. There is a window, a specific window of time, between the year you retire and the year you turn 73 and RMDs kick in, where your income is usually at its lowest. You're not getting a paycheck anymore. Your RMDs haven't started yet. Your tax bracket is probably lower than it's been in decades. And that window is the time to do Roth conversions. You convert a little bit each year. You fill up the lower tax brackets. You pay a smaller tax rate now to avoid a bigger tax rate later. And over the course of 5 or 8 or 10 years, you systematically move money from the account the IRS controls into the account that's yours free and clear. My elder law attorney explained this to me, and I sat there staring at him like he had just told me the sky was green. I said, "Why didn't my accountant tell me this?" And he said, "Harold, most accountants are focused on this year's tax return. They're not looking at your tax picture over the next 20 years. That's the difference between a tax preparer and a tax planner. A tax preparer files your return. A tax planner builds a strategy." When Linda and I started doing Roth conversions, we sat down with a financial advisor who specializes in retirement tax planning. Not our regular accountant, a specialist, someone who could look at our Social Security, our 401k balance, our projected expenses, our tax brackets, and map out exactly how much to convert each year to minimize our total lifetime tax bill. The first year we converted, our tax bill was higher than usual. That's expected. You're paying taxes now that you would have paid later. But the following year, our required distributions were smaller because we had less in the traditional account. Our Social Security was taxed less. Our Medicare premiums stayed at the base level. And every dollar sitting in that Roth was growing tax-free and would come out tax-free for the rest of our lives. Over the course of the next decade, our advisor estimated we would save somewhere between $60,000 and $80,000 in total taxes, compared to doing nothing and just letting the RMDs hit us. $60,000 to $80,000. For a retired contractor and a retired librarian. That's not nothing. That's a new roof on the house. That's 5 years of property taxes. That's James and Emma's college fund. That's money that stays in my family instead of going to the government. And I almost didn't know about it, because nobody told me. Just like nobody told my father that his Social Security was going to be taxed. Just like nobody told Tom that his 401k wasn't really worth what he thought it was. Just like nobody told Eleanor that her inherited IRA was going to double her Medicare premiums. This is the pattern. The information is out there. The strategies are legal and available. But nobody volunteers them. You have to ask. You have to seek it out. You have to sit down with someone who knows what they're talking about and say, "Tell me what I don't know." And that's what I'm doing here. I'm not selling you anything. I don't have a product. I don't have a course. I don't have a newsletter. I'm a 63-year-old retired contractor sitting in my home office telling you what I learned the hard way so you don't have to learn it the same way. Talk to a tax planner, not just a tax preparer, not just someone who files your return in February and sends you on your way. Find someone who will look at your whole retirement picture and build a strategy for the next 20 years. Ask about Roth conversions. Ask about the window between retirement and RMDs. Ask about how your 401k withdrawals affect your Social Security taxation. Ask about Medicare premium surcharges. Ask about everything, because the IRS is not going to call you up and say, "Hey, Harold, did you know you could save $80,000 if you did this one thing?" They don't do that. They take what you owe, and they don't care if you overpaid because you didn't know any better. And talk to your family about this too. If you have kids, they need to know how your retirement accounts are structured, because when you die, they're going to inherit those accounts. And if they inherit a traditional IRA, they have to empty it within 10 years and pay taxes on every dollar. That's the Secure Act. That's the law. And most people's kids have no idea it's coming. Michael knows. Sarah knows. I sat them both down and explained it. I told them exactly what they're going to inherit, how it's structured, and what the tax implications are. Not because I enjoy talking about my own death over coffee, but because I don't want them blindsided by a tax bill they never expected. The way I was blindsided. The way Tom was blindsided. The way Eleanor was blindsided. The way my father was blindsided every single year until the day he died. My dad used to shake his head at that kitchen table and say they tax you when you earn it, and they tax you when they give it back. He was right. But what he didn't know, and what I didn't know until it was almost too late, is that there are ways to reduce how much they take. Legal ways, smart ways, ways that are sitting right there in the tax code waiting for someone to point them out to you. I'm pointing them out to you right now. Don't wait. Don't put this off. Don't tell yourself you'll deal with it next year, because every year you wait is a year of that conversion window you're not using. Every year you wait is a year closer to 73 when the RMDs start, whether you're ready or not. And every year you wait is another year the IRS takes more than they had to. This isn't about money. It's about keeping what you earned. It's about making sure the decades of work you put in, the early mornings, the late nights, the years of saving and sacrificing, that those decades actually pay off the way you thought they would. You earned that retirement. Make sure the IRS doesn't take more of it than they're supposed to. I'm Harold. I'm not a tax advisor. I'm just a guy who learned this stuff the hard way. And I'll see you in the next one.